Hey guys, welcome back to another video. Today we're going to be talking about two common M&A terms used when buying a business, EBITDA and SDE, seller's discretionary earnings. And the reality is there's a big difference between the two, but sometimes people use those words interchangeably, and that's not correct. So let's talk about EBITDA. So EBITDA is defined as earnings before interest, tax, depreciation, and amortization. And it is the more common metric used by business buyers in M&A to analyze the cash flow of a business and also use that cash flow benchmark to ultimately value a business. So what you'd often hear in M&A is, I want to give you a 4.5 multiplier or a 6 multiplier on your cash flow. Well, what cash flow? What are you referring to? And in most instances, it's a multiplier of EBITDA. So in this example, if you had $1 million in EBITDA and I was willing to give you a 4.5 value multiplier on that, the value of your business would be the EBITDA benchmark multiplied by the multiplier, which gives you 4.5 million in the business value. And so what's good is that EBITDA is a very good benchmark to use across different types of businesses because it eliminates the non-cash accounting charges like depreciation and amortization, and also it backs out the financing costs that specific owner may be carrying today. So that owner may have a very tight cash flow and prefers not to put more money into the business and therefore is heavily using an operating line or is using long-term debt to finance the company, whereas maybe the current buyer has a lot of cash to put into the deal and therefore will not need those financing expenses. So you want to kind of back out financing costs as well to give yourself a clear comparison regardless of the type of owner. So the EBITDA benchmark is really a good way to kind of have an apples to apples comparison amongst different businesses and different types of owners and the equity available to them. And so in addition to the traditional, this is really the actual definition, investors will also normalize EBITDA, which is called adjusted EBITDA. And so what else are you normalizing? Well, it's really the personal expenses that the current seller of that business is running through the business is not really required, that is more discretionary in nature and specific to them. Maybe they're running travel expenses, their cottage renovation, personal vehicle expenses through the business, and really that's to reduce their taxable income. So, take advantage of really the tax system, but realistically, that's not a real business cost for the buyer. And if the buyer wants to really understand what the true cash flow of this business is, they also have to adjust out those personal expenses. And that's usually what gets done. You back out those expenses, and that's what gives you your adjusted EBITDA. Okay? So what are some common EBITDA adjustments? Well, firstly, I actually have a more detailed video on my channel, which will go into a very deep analysis in EBITDA adjustments and walking through all the relative examples. In this video, I'm only giving you a high level. The common one is owner's salary. In most instances, business owners will either pay themselves too little, they'll only collect money through dividends, or they'll pay themselves too much, and in that case, you want to normalize it to market salary. Other examples of EBITDA adjustments would be personal owner expenses, like I mentioned. I have a personal car that's not required in the business service delivery. Running personal meals and expenses, travel and entertainment, tickets to the hockey game, but I only took my family. Well, that was not really a required expense to take out a customer. You're taking out your family. And then also one-time events would be another example. COVID subsidy income. I sold a piece of property and I realized a one-time charge and booked a really big gain in that a P&L statement for that year. So these are some of the common EBITDA adjustments that investors will back out and normalize. But for this video, I want to focus on owner salary. And so I mentioned the term market salary. And what that essentially means is that it's the market salary or cost relative to the value that the current seller and owner contributes to the business. So if the business owner is working a full work week and performing, leadership services as the CEO, GM, customer relationship manager, there's a cost to that. You can't assume that, if that person goes away, you don't have to incur that cost anymore. No, someone's going to have to step in and fill that seller's shoes, right? And so we would normalize for a CEO, GM salary, which is essentially the equivalent market cost of finding someone going out into the market and hiring an employee to replace that role. And so say, for example, for a CEO salary, that may be $100,000, $150,000, $200,000 a year, and that would be the market salary for a good to great CEO. And so the way to think about it is that you want to kind of ask yourself, what is the cost to replace the services performed by the seller? And that is really the market salary for that owner. And so the best way to go about that is firstly understanding what the seller does. So ask, what areas of the business are you involved in today? What are you doing in the business today? The second one, I always ask, how many hours a week are you doing it? You may be performing valuable activities, but if you're only working 10, 15 hours a week, then we would prorate that salary for a part-time salary. And then, are you key to the business? How critical are you? Because in some instances, it can't be replaced. So if you're delivering mission critical activities, it will be very difficult to replace that role with an employee going out into the marketplace. So naturally, the adjustment to the owner salary increases because the reality is it's only owner level type payments instead of a third party employee coming in to replace that owner. Okay, so now we understand, just going back here, now we understand what EBITDA is. I'm taking my earnings before interest, tax, depreciation, and amortization. I'm backing out the discretionary expenses that an owner may carry in the business, like personal expenses, one-time events, and then I'm also normalizing for the owner's salary. So the owner's salary may be a lot, it may be a little. What I want to do is I want to add that back in full and then back out a market salary cost, which is the cost to replace the owner. Well, SDE, now that we understand EBITDA, is very simple to understand. So instead of going through the exercise of normalizing the market salary, I'm not doing that. And really, seller's discretionary earnings is very similar to EBITDA, except that instead of normalizing, we are adding back the historical salary expense of the owner and making no salary normalization. So here are the formulas for both definitions. So SDE, net income plus tax, depreciation, interest, so that's traditional EBITDA plus discretionary expenses over here, is the identical same calculation for EBITDA, but now I'm adding back the salary of the owner and the bonuses that owner paid themselves, and that is what is my SDE. Whereas on the EBITDA side, I kind of went through this in the last slide, I'm adding back the historical owner salary and bonuses, but then I'm subtracting the normalized cost. And so if I paid myself very little here and I had a high normalization here, my EBITDA would decline. Whereas with my SDE, I'm adding back the historical cost, but I'm not normalizing, therefore reducing my SDE. So what ends up happening is SDE is always higher than EBITDA, because you're grossing up the value of cash flow, making the assumption that the owner's salary is a discretionary expense that can be added back. And the reality is it's not true. So the SDE metric is very confusing, and in my personal opinion, it shouldn't be used to value a business because it really misleads the buyer into believing that there's more cash flow than there is. In reality, all businesses need some type of leader or owner, whether you're dedicating 5 hours, 40 hours, 80 hours a week, and there needs to be a cost allocated to that. So what you're doing is you need to allocate for that cost by normalizing the owner's salary, adding back the historical amounts paid, and deducting the market salary for that role. And that's why EBITDA is more commonly used in M&A. Okay, so let's go through a practice example here just to compare the two calculations. So say, for example, an owner works full-time in the business, 40 hours a week, and leads all production and operations. So they perform kind of a general manager type role. In addition, there's a personal expense that he runs through the business. He has a Cadillac that he uses largely for personal reasons with an annual cost of that lease of $10,000. So the owner is performing a general manager role, and going out into the market, you could probably hire someone to do what they are doing today for 40 hours a week for $100,000. However, the owner largely paid themselves through dividends and is only collecting a $50,000 salary historically. So we have all the key points here to really make the adjustment. So going down the line, we have net income. We start with the very bottom of the P&L statement and we go up. So net income is the same on both sides of the ledger, the EBITDA and SDE calculation. Income tax the same. Interest is the same. Depreciation is the same. So up to here, that's the traditional EBITDA calculation. Then we add back any discretionary shareholder expenses. Well, there's only one in this example. It's $10,000 car lease. In addition, now we're adding back the historical salary of the owner. Whereas on the EBITDA side, we're normalizing the cost of the owner for a full-time general manager role in the business. Whereas on the SDE side, we're not making that normalization. So this is in this example how you would calculate EBITDA and SDE, and you can see there's a very big difference between the two. So if you give a 4 multiplier in EBITDA or a 4 multiplier in SDE, you're going to overpay using the SDE metric, and that's why again I go back to why would we even use the SDE metric? Well, in the reality is, the best for private companies, you want to use EBITDA as the valuator because it's the best way to capture the stream of cash flow from the business, and it's very commonly used across the marketplace. But brokers and sellers will sometimes aggressively value the business by overestimating the true cash flow of the business and wanting to gross it up. So some will use the SDE value, adding back their salary cost and not addressing the normalization question. So in that scenario, you need to immediately communicate to them that, hey, listen, I understand that you're adding back your salary costs, but I'm going to need to normalize for that. And in most instances, that's how you address this issue with the broker. You would say, listen, if you choose to refer to stuff in SDE, that's great, but I'm going to refer to EBITDA in my offer to the business because in reality, I still need to normalize that. So, and one of the common issues with SDE when I talk to buyers is, they're saying, well, I have an SDE of 300,000. Okay. Well, the best way to think about SDE is if you're working a 9-to-5 job, you're collecting $100,000 a year in salary, and you're looking to buy a $150,000 SDE business. Well, do the normalization. Okay. A CEO salary is normalized at 100,000. So truly the net EBITDA on 150,000 may be only 50,000. So the question is, do you want to leave a job to essentially have 500,000 in accretive EBITDA for an investment and put your capital at risk? Well, probably not. And that's the reality. The most common mistake that we see when people use SDE is that they're buying another job. They're not really accounting for the true cost of themselves coming into the business, the true cost of a CEO salary. So it's always important to look at adjusted EBITDA instead of SDE, which grosses it up. So here's the final example. So I just pulled this off a business listing website, and I'm going to go through and give you kind of a live take on, this is an example business. It's, professional services firm, $360,000. The broker in the listing online has already provided the SD amount, which is $183,000 on 360. So it's about a 2 times on an SD basis. So they've adjusted all of the non-business costs, the discretionary costs, but they've added back the owner's salary. So my very first question, if I was in the buyer's shoes, is after reading the description, I want to understand what is the normalization that I should factor in so that internally I understand what the true EBITDA of this business is. Okay, so what is my time worth if I'm going to step into this business and take this over? And the questions that you need to ask would be, how many hours does the owner work a week? What do they do in the business? And what do you think the cost is to replace that owner? Sometimes they'll answer that last question. Sometimes they won't. They'll say, I don't know. And then you have to do that research yourself. So in this example, I would refer back to the description in the business listing and saying, operated out of a home office with the current owner working part-time. So we know that there's no full-time cost here for the owner. So in the first example, the broker will come back and say, hey, this owner only works 20 hours a week, so part-time, so 50% of the week they work. And then what does the owner do? Well, the owner handles sales, invoicing of new jobs, and manages the bookkeeper, manages the one staff. So the manager in the marketplace may cost $70,000 in a full-time position, but on a part-time basis, we probably estimate that it's going to cost anywhere to $40,000 to $50,000. So assuming that the cost is $50,000 on a prorated basis for this owner, I take the SDE of 183 and I back out and normalize the cost of that owner to get the true cost of that EBITDA, which is now $133,000. And so that's the metric that I would be using to analyze this business, because now I've properly accounted for my cost of time going into the company. Okay, so hopefully you guys found the video helpful. If there are any questions, please comment below, or you can reach out to me over LinkedIn or through my website at robleecapital.com. And if you have any questions about buying or selling businesses, please reach out. I am a business broker based in Toronto, Canada, and I primarily sell businesses below about $25 million in enterprise value. So I'm primarily in that lower mid-market space. And, oftentimes I do run into SDE. So this is why I made this video. So hopefully you found the video helpful. And if so, just take care and have a great day.